Yeah, sorry, my tiny office is pretty cramped, but let's jump in. I want to talk to you about credit scores today and why it's so important that you understand what credit scores are and how they affect your chances of getting a mortgage. It's going to be very simple. As usual, it's going to be very straightforward. Let's start with a story. So back home in Nigeria, where I'm from, if you want to buy $1 million house, you need to have $1 million in your bank account ready to go. Like, no one's going to give you a mortgage. Well, they might, but you need to be of a certain class of people. We don't really have that much of a credit culture in Nigeria. Everything is debit, cash down, good to go. It's not like our banking systems are crazy. It's just that that's the culture that we have back home in Nigeria. Our banking systems are actually quite fantastic. But when I moved to Canada, I knew that I'll have to get into this zone of a credit culture where I'll go to the grocery store, Real Canadian, my favorite, shout me out, love to shout you out back. And instead of paying with a debit card, I'd have to pay with a credit card, as my wife kindly let me know many times. You see, I wasn't the type of person to use my credit card because I didn't want to have any sort of debt in my name. Culturally, it's kind of bad. No one likes to have debt in their name. But when I saw that it was going to be very instrumental in helping me to get the house that we were trying to buy at the time, I started to use it quite often. So anywhere I went, I would develop the bravery to use my credit card. And that's how I was able to build my credit history and obtain a quite fantastic credit score today. So the question came to me when I was making this series: how do I describe credit to someone that is from the same culture or someone that is in the culture but just never decided to use their credit card in the first place? So say it this way. Every time you go to a grocery store, Real Canadian, shout me back, love you guys, and you use your credit card, what you're essentially saying is that, hey, Real Canadian Superstores, take $100 for all the groceries that I'm going to buy today from the bank, TD Bank, RBC, whatever bank you use, and at a later time, I am going to pay the bank back. So why this merry-go-round? Why this running up and down just to get some groceries? Well, every single time you use your credit card and you pay off your credit card on time, which we'll get into later, the bank is keeping a score of what you're doing. The bank is keeping records of my ability to pay back the money that I borrowed. Essentially, if you heard it right, you're literally borrowing money to buy groceries and then paying the bank at a later time because Real Canadian debited the bank and the bank is going to debit you. And if you do this over a long period of time, you start to develop something called a credit history, meaning that if you pay your bills on time and you make sure that the bank is happy whenever they ask you for your bills and you deliver, then you have a good credit history. And it is from these small little things, these payments, this regularity of payments, combined with certain other things, if you've watched my mortgage video and down payment video, that they then use to determine whether you are a low risk person or a high risk person in terms of paying your bills on time. Whenever you go and get, or whenever you apply for a mortgage, they're looking at that credit history and the corresponding credit score to determine if this person that wants to buy, for example, a $500,000 house and needs a $400,000 mortgage is going to stick to the contract. That's exactly what we are going to talk about today. Credit scores, why they're so important when you're going to apply for a mortgage, and pretty much a little bit of tips here and there to make sure that you get a good credit score and you know how to keep it that way. Let's go. So we've had a blistering opening. We've crushed and condensed everything into one tiny package. And I hope you've got the background of why your credit is important, why your credit score, credit history is important. Let's go a bit deeper into how to build your credit so that you become this very desirable and low risk person that the bank wants to give a mortgage to. And if you've been in the country, if you've been in Canada for quite a long time, these will sound like things you've heard many times before. But if you've been in Canada and you've not heard these things, or if you're new to Canada, it's very important to use these tips to build your credit so that when it's time to apply for a mortgage, you're not running helter-skelter trying to fix things that you should have fixed a long time ago. So number one, if you want to build your credit, you need to get a credit card and you need to lower the use of your debit card. So for example, in the Real Canadian Superstores grocery example, I'm using my credit card to buy groceries. Real Canadian debits the bank that I use, and the bank that I use sends me the bill for the groceries that I bought. And after a specific period of time, the bank that I use is going to ask me to pay back that money just to see if I am credit worthy, meaning that later, whenever I come to them to borrow money, whether it's a mortgage or anything, they're going to look at all of that and they're going to see that, oh, this guy pays his bills on time. But let's keep this thing a bit structured, shall we? I've been rambling for quite some time. So get a credit card with a normal credit limit. Credit limit means that on your credit card, you're allowed to borrow up to a certain amount of money. So when I first came to Canada, I got a credit card. My credit limit was $1,000. So this means that whatever I wanted to buy, I couldn't buy more than $1,000 with my credit card. Now, the reason why you're using a credit card is because you need to build your credit history, a history of your ability to constantly and religiously pay your bills in a fashion that is agreeable to your bank. Now, to build your credit score, to build your credit history, you also need to know your billing cycle. So it's just like the name sounds, and I'm going to keep things very simple. You should ideally be speaking with your financial advisor or calling your bank for this information, but this will serve as an alert for you to do so, and this will give you an idea of what you should be looking out for and how to structure that conversation for your situation. That's why you're here anyways. So a billing cycle is normally 30 days of spending activity specified by your bank. So a billing cycle, for example, is like January the 1st to January the 30th. All the spending that you've done within that period is being calculated on a billing cycle, within a billing range or billing time. It's just an amount of time that they're using to specify how much money you've spent on your credit card. Now, after your 30-day billing cycle, usually 30 days, please check with your bank. You then have a period called a due date, and this is usually, please check with your bank, 25 days after the end of your billing cycle. So you have that 25-day period to pay off everything that you spent during your billing cycle. Personally, I don't wait for my due dates to arrive. I don't wait for that 25 days to arrive. I make a habit of paying down my credit card as quickly as possible. Some will disagree with that, some will agree with that. It's just because I came from a culture of not having debt in the first place. So even having a mortgage of such a large amount of money to get this house is still bothering me. So I like to pay my bills on time, which is a habit that you should imbibe. You should have that habit. Pay your bills on time, just so no one has any excuse to call collections, which is the boogeyman of credit cards. Those are the people that chase people down when they don't pay their bills. And whenever they have to call collections, they've already impacted something called your credit history. We've spoken about that as well. It's going to be on your record for 7 years that you have a habit of not paying your bills on time. And anytime a lender sees this, they tend to kind of walk away from loaning you any money because they don't want to be the guys holding the bag when, for example, you are spending time in Punta Cana with a credit card. So yeah, this is a very quick video. Like I said, to make sure that you're on the right with your bank, make sure you call your bank or call your financial advisor to give you proper, grounded, wholesome advice about your credit card, how to use it to build your credit history. But my job today is just to let you know that credit history is very important. As a quick summary, get a credit card, use it wisely, pay your bills on time, know your billing cycle, know your due dates. Know that if you mess up and you don't pay your bills on time, that's going to stay on your record for 7 years. And even after that, there's still repercussions. And when you have all that together, make sure you defend your credit score and you defend your credit history with everything you've got, because it's going to be a very, very integral part of getting that mortgage that you need to get your dream house. So with that being said, it's been a very quick one. I know I'm talking quite fast. I'm very excited. Something happened. I'll just tell you about it later. But yeah, thank you very much for watching. I'll see you in the next video where we talk about how to choose a house that makes you happy. Finally, we're out of the studious part of house hunting, learning about mortgages, interest rates, and all that fantastic stuff. Now we're getting into the meat of the situation. How do you choose a house that makes you happy? A house that won't give you any headaches. Thank you very much for watching, and see you in the next one. Bye.